The stock in this video began as a business unit in General Electric in 1977. In January 2005, it separated as an independent company and went public since 2007. And since that time, it has been one of the most consistent growers in all the stock market. Watch this video to learn more about this exciting small cap company. The company we're featuring in today's video is an unknown company called Genpact. It has a $6.5 billion market cap. It is investment grade with a BBB- credit rating from Standard & Poor's. It has debt less than 40%. It currently yields 1.51% in income and has an earnings yield of a very attractive 7.99, or we'll call it 8%. Now, as you can see by the fast graph here depicting operating earnings only, adjusted operating earnings, you can see the first year the company had a rather remarkable year. However, I think it is fair to scroll that out because earnings growth averaged 14.75% since it went public. However, if you take out that one anomalous year, you'll see that the growth rate drops down to between 9 and 10%, pretty close to 10%. But I want you to notice how consistently it has done that. Now, when I put price, weekly closing stock prices on the graph, like so, I also want you to notice that the company's stock price has really followed earnings from time to time, becoming undervalued, overvalued, fairly valued, overvalued, fairly valued, even undervalued, and today it sits undervalued. This is very important because I want you to note that in the long run, the company's earnings determine their market price, but in the short run, volatility is real and the stock price can get overvalued or undervalued, and the market often misappraising the stock. But yet, because of the consistent growth of this company, you could even overpay for it at times and still not do too badly as an investment. Here we bought it at a very high valuation where the PE ratio was 21, and we held it, to where the PE ratio has now fallen to 12.52. And, yet we still made a positive rate of return. But I do want you to notice the volatility. During this time, the market has traded it between 15 and 18 times earnings. That's the orange and blue line on this graph. And there were times when it even got above that 18 times earnings and time when it even got below the 15 times earnings. But again, the consistency of this company cannot be ignored. Now, as far as dividends and the dividend payout ratio, I want you to note that the company has paid out somewhere around 16% to 20% of their earnings in dividends every year. This going forward is forecast, and we're going to ignore that for the time being. What I really want you to focus on is the fact that the company has raised their dividend every year since they paid one. Now, they did pay a special dividend in 2012, which will impact the growth rates and so on, as I'm going to show you here in a moment. But take in mind, this was a special dividend. They didn't really start paying a regular dividend until 2017. What intrigues me about this company is currently the valuation. It is a consistent grower. It is expected to continue growing at around 7 to 9% going forward as far as earnings growth goes. And that would make it very attractive at today's valuation. Now, looking at other metrics, if I look at GAAP earnings or diluted earnings, what I showed you first was adjusted earnings. We get a slightly different picture, but still very, very similar. The company's earnings have, consistently grown on a diluted basis like they did on a GAAP basis. But here's the important stuff I want to show you as far as this company goes. It is paying a dividend. So when I look at operating cash flow, I do see a high correlation between price and cash flow. And the stock does look undervalued on that basis as well, with cash flow expectations expected to be very high going forward, and they do cover the dividend. Ignore this because this is just analyst estimates, and I don't think they're very trustworthy right now. As far as, there's not very many, you'll see that there aren't many analysts who are forecasting dividends, and they're all over the place. But when I analyze this and look at it from operating cash flow and free cash flow, what I do see is, based on the actuals that the company has actually achieved, their free cash flow, which is this orange line here on this graph, this is the free cash flow graph, has been significantly higher than their dividends. They generated $1.53 in free cash flow in 2017 and paid a 24-cent dividend. Expected to generate $2.24 this year and pay a 55-cent dividend. But the bottom line is the dividend is extremely well covered. So even though it's not a high dividend payer it does have a high dividend growth rate, as I'll show you here in a moment. I'm looking at other metrics here. If I look at it from a standpoint of EBITDA, earnings before interest, taxes, depreciation, and amortization, I once again see great growth. I also see the stock looking extremely undervalued based on EBITDA. And then EBIT, I was criticized in my last video for not showing EBIT, so I'll show it this time. That's earnings before interest and taxes, not showing any non-cash stuff like depreciation and amortization out here. We look at EBIT, and it looks very, very undervalued on EBIT, and EBIT growth has also been very strong. From a top-line point of view, sales, the company's been a very consistent sales grower at double-digit rates, over the long run here. And I'll go ahead and expand this out. Sales growth is expected to continue growing at, pretty high level, at least 7 or 8% going forward. All right, so the key about Genpact at this point is that earnings do follow its market price. Its normal valuation has been around 18 times earnings, again, going above that and below that from time to time. Excluding forecast data, which I'll cover here in a moment, the stock looks very, very undervalued today based on its historical operating results as well as its, moving forward. So, what I see here at this stage is I really like this company, and I really like the fact that this is one of the first times you could buy it when it was undervalued. Now, as I pointed out, it was a spinoff from General Electric. What the company does is it's a global professional services firm. This is right from their website, delivering the outcomes that transform our clients' business and shape their future. The company is a BPO company, business process outsourcing. And, they're very, very well positioned. They rank in one of the top 20 data companies in the world, according to sources. And what business process outsourcing is, it's a method that companies use to subcontract various business-related operations to third-party vendors. In other words, things that maybe are redundant or things that they don't want their management, being burdened with. They can actually utilize business process outsourcing to do that. Okay, it does utilize third-party vendors or subcontractors to carry out these aspects of their business. So, that's, I think, real important. But it does help businesses focus their management horsepower, if you will, on the companies, on the critical operations that they can use to grow their business and not having to be, bogged down by some of the more, we'll call it, less than exciting aspects of running a business. Now, Zacks points out that, Genpact holds a prominent position in BPO services market, and that they feel that they leverage their expertise in business analytics, digital, and consulting services. Zacks also believes the company recognizes a substantial growth opportunity in artificial intelligence, or OI. They give it an impressive value score of A, and that's clear by looking at this fast graph. The stock does look like it's very inexpensive right now. And it condenses all the metrics from the company's financial statements with their scoring system to get a true sense of the quality. Now, I've got a special treat for you on this video. I have invited Professor Nathan Mauck, who serves as a consultant to Fast Graphs. For those of you who don't know Nathan or haven't seen him around the Fast Graph site before, he's an associate professor of finance at the University of Missouri in Kansas City. He holds a Ph.D. in finance from Florida State University and an undergraduate degree in finance from Kansas City State. He's won numerous teaching awards primarily for courses focused on valuation. And that's, of course, why he's near and dear to my heart, because he is a valuation expert. And he has published over 20 peer-reviewed academic research journal articles, a textbook, and various book chapters. And he's been featured in popular publications such as the Wall Street Journal. So what I've asked Nathan to do is go through the company's financials here. So I'm going to turn it over to Professor Nathan Mauck at this point.
So taking a look at the financials of Genpact, and really any firm, I really like to get at anything that relates to growth and risk. And so to start with growth, this is just the historical chart. All the price and other things have been taken off of here. You can just see overall what's happened with sales growth over this last time period. They've averaged about 12% per year. When you switch over to adjusted operating earnings to get a sense of what happens at the bottom line, you see a similar picture. So this is a 14.75% adjusted growth rate. And what this tells me is they're able to grow the top line and the bottom line at a healthy rate. Also, if you just look at the shape of this progress, we have two major crisis periods in this graph. So we have the financial crisis at the very beginning, and then of course we had the COVID period. And I would, just really notice that they have no negative earnings period. So they always have made money over this period. And, the trajectory of the growth has been pretty stable. So this seems like they do not have particularly risky earnings and risky sales, and also solid growth. So that's pretty exciting to see. If you look at the analyst forecast, the expected growth, you can see it's 7 and 9% for the next few years. And so consistent with certainly the track record they've put up, seems like that's doable based on the past. Another thing that I like to look at that gets at both growth and risk to some extent is the analyst scorecard. And so one idea is that the more accurate analysts are, probably the more predictable the business is, the less risky the business is, the closer that what the firm sort of says they expect to reality, that gap is pretty close. And if you look at the 1 year numbers, that's a 92% hit rate here in this chart, beat 8% of the time, 2 year with 100% hit rate. If you just look at the individual differences, there are a few negatives, but no misses by sort of more than 10% anywhere on here. So, at least historically, what analysts are expecting, plus or minus a little bit, that has been reality. So again, this indicates that those growth projections that analysts are making probably have some merit to them based on the past, and that also this is evidence that this isn't an overly risky, volatile, hard to predict business, which I think is informative. So another question that we have is, is this a solid company fundamental? Are they healthy? Are they able to meet their obligations? And the fiscal fitness segment of Fast Graphs has a lot of great information, but I want to just focus on a couple that are particularly interesting to me. The first is margins. And so we see different margins presented here. We've got a gross margin, an operating margin, and a net margin. And the first thing that stands out is these bars are relatively level over time. So they've had a healthy margin. The margin doesn't have a lot of volatility to it. It's relatively stable. That black line represents the industry average. So they've been a little bit above industry average gross margins for this whole period. The operating margin with a little more movement to it, and recently a little bit below the industry line, but still healthy operating margins that have remained pretty stable, especially starting in 08 on. They've maintained within a relatively tight band there. And same thing with net margins, stable margins over time, kind of in line, maybe a little better some years than industry averages. So that's definitely something I look for. As far as accounting-based measures of performance go, we can look at different return on measures. I like return on equity as one. What we see here again is return on equity has been pretty stable. About an 18, high 18%, 19% the year prior, stable above industry average. So, this kind of measure of performance or efficiency looks pretty good. We see something similar if we look at return on assets or return on invested capital. They all tell more or less the same story that the margins did, of consistency, which speaks to relatively low risk. Another item that sometimes folks are interested in is, debt. Is the debt level too high? There's a few ways that I would probably approach that issue. First is to look at the debt to equity over time. So they did have a little bit of an increase, in 2012, and then have maintained, relatively stable along that period. Certainly this debt to equity is, not real high, but other areas to go look at the health of the business and the debt would be the health check. Has some great information here, and there's a long-term debt to capital, which gives us just a little bit of a different perspective and different look in some industry averages and kind of where they're at. And then finally, I also like to look at the financial statements directly. And one of the first places I'll go for debt is I'll go to the balance sheet. And within the liabilities section, there's always a long-term debt item. So that's about 1.4 billion in long-term debt at the last fiscal year end. You can see they've been around the 1.5 billion mark, for about the last 5 years. And so, is that too much? Is that too little? Well, we kind of have to compare it to something else. So just a couple things I would compare that debt number to is that's about, let's call it 1.5 billion, just rounding. If you look at the cash they have on hand, they keep, about 600 million-ish on cash on hand at any given time. So that would cover, a relatively decent chunk of the debt. And so another thing that we can look at, though, is, they making, enough money to support the debt. And there's different measures certainly we can look at, but EBITDA is one that I like, and they've been doing about 600 billion in EBITDA here annually. So on $1.5 billion in debt to have 600 billion EBITDA, that coverage looks pretty healthy. So it doesn't seem like their debt is out of line or a real red flag for risk. Operationally, they've been pretty consistent, and they've had consistent growth, expected to have pretty solid growth going forward. So that's what the financials tell me about Genpact.
Thanks, Nathan. That was an excellent review of the financials of Genpact. As again, the company kind of deserves its S&P credit score of BBB-, I think. And the fact that their debt is not only manageable, but relatively low, I think is another plus, especially, since interest rates have been rising, although they may be dropping. So let's get back to the fast graph here and my part of the presentation where I look at forecasts going forward. Now, analysts are forecasting good earnings growth for next year at about 6.9%. We'll call it 7%, 9% the following year, and then 9% after that. I think this is where AI would begin to kick in. If you looked at a 15 multiple based on an 8.5% grower, you'd be looking at, realistic rates of return of 31% by the end of this fiscal year and calendar year, which is 2024. That means the PE ratio would go from 12.52, where it currently is, to 15. Going out another year, we'd be looking at about a 20%, 19.5% rate of return. Again, same logic. That's assuming the earnings did grow to 337 and they averaged a 15, and they traded at a 15 multiple. If we apply the normal multiple for the last 5 years, which has actually been 19, as I pointed out in my original remarks, that's a little high than what I'd call the historical average. So I'm going to use this number here, 18.15, which is a very good proxy for historical. That would really give us an incredible annualized rate of return for 2024 of over 61% and an annualized rate of return of over 31% out to 2025. I'm excluding 2026 because there only is one analyst, and I don't feel that these numbers are real good. However, as Nathan pointed out, the analyst scorecard in this company is actually excellent. So it appears to be a company that the analysts have a relatively effective and easy time of forecasting. But I want to stress this a little bit. I want to go to the conservative number here and look at this 15 times earnings. Now, one of the real benefits you have here with fast graphs is the ability to simply point to a part. If they were traded at 15 times earnings, you get the scale out here on the side of the graph. That's what the return would be. If they only traded at 12 times earnings, which is slightly below what we see now, it would only be a 3% rate of return. If they traded at, a little higher, 13.5 times earnings, it'd be 17%. Again, if they traded at their 18 or 19 times earnings, it could be 60 to 70%. So the beauty of this is you can run the numbers out to a logical conclusion, which is something I've always support. Now, looking at the historical performance of the company, I want you to note that going on the max level here, that the company has underperformed the market. But I'm going to explain something to you here in a moment. If I drop that to this 15 years number, they still underperform the market. If I drop it to the 13-year number, we still see them underperforming the market. But I want to show you, I want to introduce here or pre-introduce a new feature to fast graphs that I think you're going to love. Those of you who follow my work know that I talk about, if you're measuring performance without simultaneously measuring valuation, it's a job half done. The point I want to make is we're measuring Genpact when it's undervalued versus the S&P 500 when it's overvalued. Now, this is a new feature that we're going to be offering on our new version of fast graphs, which we should be launching here relatively soon. And what this shows you is a portfolio performance report where we compare it to the S&P, and more importantly, we compare it to the company's earnings. Now, again, remember we had this one really crazy year up front, so I'm going to eliminate that. And what I want you to see here is that Genpact has generally traded where the blue line is below the blue dotted line. The blue, wiggly line is below the blue dotted line most of the time, and it's currently significantly below it right now. That simply means that Genpact is, underperforming its earnings growth, where the S&P, the orange, and I'm going to take Genpact off of here for a minute so you see it, exclusively, is trading above its earnings line. Now, we've also added a valuation comparison. So if I'm comparing Max here, I'm comparing both companies from being overvalued, or both entities from being overvalued, where the S&P is now overvalued above its earnings justified line, which is the yellow dotted line, and they're the same number here. They're both at a 15 PE, and where Genpact is well below that. Now, as I change these time frames, I want you to note that you're going to see changes in valuation. Now you have Genpact being slightly overvalued and the market being more overvalued. But once again, the S&P is way overvalued. Genpact is undervalued. I close this down. Actually, I'm going to close this down to 9 years. And we see both stocks started overvalued. Genpact is now currently undervalued. The S&P is overvalued. The moral of the story is measuring performance without simultaneously measuring valuation is a job half done. It is true that this company has underperformed the market, but it's not true that it's not performed as a business as well as the market. What's happened is the stock is currently undervalued, but you can see that it is starting to move back into alignment with its valuation. So this is an interesting company, and the consistency that Nathan and I both featured in our parts of the presentation here. I think it's an opportunity to buy a really high quality company at a low valuation. They've got some opportunities coming up in AI. As always, I recommend that subscribers go to the corporate website and learn about the company, learn what industries they work in, learn what their businesses are, learn what their services they offer, and learn as much as they can about the company, as well as doing other fundamental due diligence and research. Investing without doing your due diligence is also a job half done. Anyway, this has been Chuck Carnevale. Thank you for watching. Hope you enjoyed this on this relatively unknown small cap called Genpact. Again, a spinoff from General Electric. It started in General Electric in 1997, was spun off in 2005, and then it's gone public. Went public in 2007, as I've shown and featured many times here. The earnings growth has been really good. The dividend, they started paying a dividend in 2017, and thus far, not including estimates, the company's increased their dividend every year. They have a very low dividend payout ratio, so there's a lot of room for growth. So here's one you might want to take a look at a little closer and start doing your own due diligence on Genpact, the spinoff from General Electric. Thanks for watching. If you liked the video, give me a like, ring the bell. Subscribe to our channel if you don't already, and also take a look at subscribing to Fast Graphs. I also want to point out, for those of you who are interested in affiliate marketing, we've provided a link to our affiliate marketing program that we've recently launched here, and it's a great way for people who love Fast Graph to spread the word and be well compensated for doing it. Thanks for watching.